Hello, welcome to IGTV's Trading the Markets. I'm joined by our guest all the way from Washington, D.C., Chris Versace, CIO of Tematica. Thank you so much for joining us so early in the day. I guess the biggest question that all our viewers wanted to hear about is this pivot in the rate expectations. Suddenly everyone's looking out for this Fed rate cut by spring. Do you think this is just everyone getting ahead of themselves?
Well, if we take a look at the market, I mean, the S&P 500 went from being oversold in late October to, depending on the indicators you're looking for, short-term overbought, potentially even intermediate-term overbought. And the big driver of that has been the notion that inflation is indeed once again accelerating to the downside. We saw that in the October CPI report and the October PPI report, but actually showed the deflation in the intermediate category. So, I think the question is fair. Let's remember, though, that we have seen the market continually over the last year get ahead of itself, over anticipating what the Fed may do on this fight. And do I think that we're likely to see the first rate cut in the middle of 2024? I think that's the case. Maybe that June-July meeting. Yesterday we got the Fed meeting minutes from November. There wasn't even a word mentioned of a rate cut. So I think we're going to need to see more progress in the data. Remember, we will get the October PCE price index next week. And then before the Fed's meeting in December, we'll get another round of CPI and PPI data. I think at that meeting is when we'll start to hear them start saying, okay, what would it take for us to cut rates? Let's start having that conversation. So we do, I think, have a risk inside the market that, yes, it's over anticipating what the Fed may do, or I should say, how soon it may do something.
Of course, at the same time, Chris, the dollar has fallen, looking at the US dollar basket there since that pivot. But the job market, just looking at the data earlier this session, job market continues to confound economists as well as those forecasting or were forecasting a 2024 recession. A number of Americans filing for new unemployment benefits fell by 14,000 over the week ending November 18th. And also, perhaps the retail figures that we're going to see coming through, do you think that might show us perhaps a tick up in inflation as well? Or perhaps it hasn't really gone away, that problem?
So I think if we look at some of the data that we've got, and including some of these aggregated rolling GDP forecasts from various Fed banks, they all point to around 2.2% GDP for the current quarter. Now, to be fair, we have a lot more data to go. We're only halfway through the quarter. But so far, the speed of the economy in the current quarter is, on par with the first half of the year. Yes, slower than that hot 4.9% print for the third quarter, but it's not falling off a cliff. And so far, it would seem to suggest that we're on a glide path. This soft landing is increasingly likely. Now, we're going to want to verify that with some upcoming data, and later in the week, we get the flash PMI numbers from S&P Global and various other entities for the month of November. That, I think, is going to really tell us what's the true pace of the economy. Again, my thinking is that we're on this glide path, but in terms of inflation and the employment market, the one concern that I continue to have, Angeline, is wage pressure continuing. We've seen, a lot of wage pressure start to get baked into the system. What I'm referring to here is the Teamsters win against UPS, right? The Detroit 3 and what they have done with the UAW in order to settle those strikes. But there's other indications out there that wage pressure continues to be a problem. We've talked about this, what it means for fast food workers in California in 2024. My concern remains that for companies to contend with all of this, pricing could continue to creep a little bit higher in 2024, slowing the impact of what the Fed is looking to see. That's why that's one of the reasons why I think we're more likely to see a rate cut around the middle of the year, not necessarily as soon as some of the indicators suggest, which, around the March timeframe.
Of course, the final piece of the puzzle is energy in terms of inflation, with oil prices falling some 4% this session after OPEC Plus producers delayed that meeting slated for this weekend. What is your outlook for energy prices, and what might that mean for inflation for the US economy in the months ahead?
Well, falling energy prices have been a big factor in the declines that we've been seeing, most notably in that October CPI and PPI reports that I referenced. So we will want to keep a very close eye on it. My sense is that we're going to continue to walk a very tight supply-demand tightrope in the near term. On the supply side, the question is, will OPEC extend the production cuts into 2024? Might they even raise those production cuts, given some concerns that they're seeing? But at the same time, you know, we talked about the U.S. economy really kind of being on firmer footing than previously expected. We also know that China has, you know, brought out a lot of stimulus to its economy. We'll want to keep close watch on that when we get their November PMI data, including the order data that'll be an indication for December. So my sense is, if the supply-demand dynamics point to a little more tightness, that means we're likely to see oil prices creep higher. That could pose another threat to the speed of inflation pressure waning.
And finally, Chris, a Thanksgiving tradition is back. Hectic travel and, of course, shopping. Who do you think are the likely big name companies and brands that are likely to benefit?
Well, you know, typically the big, you know, shopping weekend is Black Friday to Cyber Monday, but here in the States, we have seen a pull forward in that, seeing Black Friday deals as early as this past weekend. So retailers are really out trying to capture whatever they can. But I think we're going to see a continuation of what we learned in recent retailer earnings. So what I mean by that is a vast majority of them had negative comp sales for their October quarter. That tells me that consumers continue to be very selective, very choosy. When we look at companies like Target, Home Depot, and the like having negative comps, but Ross Stores, TJX companies, essentially the discount retailers having positive comps, that kind of reaffirms my position on this. From my perspective, who do I expect to see win? Not just the holiday shopping week, but also the holiday shopping season. I continue to favor the shares of Amazon and Costco.
Right, we have to leave it there. Thank you very much. And safe travels to Connecticut, Chris Versace there, CIO of Tematica. This is IGTV.